At dawn on the coast of Abidjan, manual laborers operate on the margins of the global economy, moving cargo by hand to fuel local markets. Within 25 years, projections suggest this coastline will host an automated logistics network, exporting complex manufactured goods to the global market. This chart shows 2050 GDP rankings. Soon, 6 of the 7 largest economies will be emerging markets, unseating the G7. Synthesizing data from the World Bank, IMF, and Goldman Sachs, we identified 10 nations with the resources to achieve high-income status by mid-century. Global wealth generation is shifting away from the North Atlantic, with the majority of growth now concentrated in the developing economies of Africa and Asia. Number 10 is Uganda. While much of its workforce remains in subsistence farming, the nation sits on 1.4 billion barrels of commercially recoverable oil beneath the Albertine Graben. The global shift away from fossil fuels creates a narrow window for this strategy. If demand peaks before the multi-billion-dollar East African crude oil pipeline is paid off, the project risks becoming a stranded asset. Number 9, Cambodia, has driven expansion by concentrating its urbanizing workforce in export-oriented garment manufacturing. The state is now attempting to pivot toward regional logistics with the Funan-Teco Canal, but this infrastructure relies heavily on Chinese capital, creating a high level of external debt dependency. Number 8 is Rwanda. To offset the high transport costs of being landlocked, the government is bypassing traditional heavy industry to build a digital services economy in Kigali. Number 7, Senegal, is launching offshore liquefied natural gas projects intended to provide the cheap domestic power required to lower national manufacturing costs. For these states, escaping the low-income bracket depends on successfully commercializing their natural resources before global energy transitions or trade shifts close their opportunity for growth. Number 6 is Tanzania. The nation is positioning itself as a regional logistics gateway, building a massive railway network and negotiating a $30 billion gas project to capture trade across the Indian Ocean. However, Tanzania's national debt grew by over 25% in less than a year. Servicing these liabilities now consumes roughly a quarter of government revenue, limiting the funds available for education and health. Ethiopia, at number 5, is betting on industrial scale. The state-funded Grand Ethiopian Renaissance Dam provides the low-cost hydroelectricity required to power industrial parks for a population of 120 million. Despite this energy advantage, Ethiopia recently entered sovereign default. This financial status, combined with ongoing internal conflict, continues to deter the foreign capital needed to sustain its manufacturing growth. Number 4, Côte d'Ivoire, has become West Africa's anchor by maintaining stable fiscal policies under IMF programs, allowing it to attract investment despite regional instability. While Ethiopia and Tanzania face mounting fiscal pressure from their projects, Côte d'Ivoire has reduced its deficit to 3% of GDP while keeping inflation under control. This graph compares the debt to GDP levels of these 3 nations. It illustrates that for these continental anchors, long-term growth is tied directly to their ability to maintain fiscal discipline. Number 3 is Bangladesh. The country has utilized its population of 170 million to build a global manufacturing hub, outperforming its neighbors in female labor participation and life expectancy. To maintain this momentum, Bangladesh must now upskill its workforce to move beyond garment assembly into electronics and pharmaceuticals, all while managing the rising costs of climate adaptation. Number 2, Vietnam, has become the primary destination for global electronics manufacturing. It is rapidly gaining the complexity needed to produce semiconductors and advanced machinery. Vietnam also holds 3.5 million tons of rare earth reserves. This gives the nation strategic leverage in the green technology supply chain, as global powers seek alternatives to Chinese minerals. Number 1 is India. Massive infrastructure spending and a digital banking revolution are formalizing the economy, positioning India to overtake the United States in size by the 2070s. India's trajectory depends on job creation. If the state cannot generate millions of formal manufacturing roles for its entering workforce, its demographic expansion risks turning into a period of high underemployment. For these 3 nations, the momentum of their supply chain integration and population growth places them at the center of the 2050 global economy. By 2050, the aging nations of the North Atlantic will look to these emerging markets for their working-age labor and expanded consumer bases. As global powers compete for the minerals and trade routes in the global South, these nations face the risk of debt traps and resource extraction that fails to benefit their local populations. The wealth of 2050 is moving to the developing world. Its long-term success rests on the capacity of these states to manage their own resources and dictate the terms of their growth.